It'll cost Skye $47,500 for the compensation scheme, plus the ASIC levy. So ASIC get funded by us, and if they, fumble the ball, then we just pay the bill anyway.
90 complaints in 1 year is quite high. We're looking at a couple of class actions, up to 500 million, I think. If you can go after someone, you're going to want to go after someone.
Yeah, like why wouldn't I? The compensation scheme of last resort really is, it's someone who goes into a bank and robs the bank. And then the bank says, for us to be made whole, anyone who's ever walked into this bank in the past needs to pay us back this money. And the government going, yeah, you know what, that's good, let's do that. Hey there, I'm Phil Thompson, and today we are doing a deep dive on compensation scheme of last resort. Today I have Ash. Thank you for joining me.
How's it going, Phil?
Great.
Fabulous.
So this compensation scheme of last resort is difficult, complex, and has got many layers, like a good onion. So we're going to try and peel back this onion layer by layer and try and understand what it means, and also like why it actually matters for our clients. We're going to be talking about like what it is, how it works. We're going to be talking about some of the big cases and the cost with regards to the compensation scheme. And then we'll talk about what are the flaws and how does it actually impact our clients.
Yeah.
So what is compensation scheme of last resort?
So just to go back a little bit, it was first raised in 2017 after the Banking Royal Commission, or during the Banking Royal Commission process. It was flagged in 2017, started to get a bit more talk again 2019. By 2023, it was finally proposed what it was going to look like. And then by April of last year, 2024, that's when it finally came together. So it's been in the talks for quite a while. But was sort of spurred on a little bit more around, particularly when the Dixon financial situation started coming to light. So we'll talk a bit more about that later on.
Yeah.
This compensation scheme of last resort is a mechanism to support customers, clients who have lost significantly financially, and the company is no longer around to pay any compensation to them. The scheme is set up so that each person can get access to, I think, 150,000 at most, depending on the circumstances.
Yeah, when it was originally proposed and talked about, it was kind of like talking about a few $100s per advisors. The idea was great. Okay, yes, there's bad advice and there's bad things that happen to customers, and we want to make them whole. So great, we can all pitch in a little bit of money to compensate consumers for bad actors. We all get a bad name for bad advice anyway, and so making sure they're made whole is kind of a good thing to do. Now, fast forward, and some of the bills that have been coming in, or at least proposed to come in, is starting to be a big concern. There are three major cases I want to touch on, and we're not journalists, so we haven't we've actually prepared more than I've ever prepared for a deep dive, and we're still very confused with what the heck is going on.
I feel like it would take a week of just solidly looking into this to maybe have a strong understanding.
Yeah, and there are some great journalists within the industry, with our industry publications, that do some really good work in this area, and so we've lent a lot on their hard work. But the three cases I want to touch on is like Dixon Advisory. What's happened there? The second one is there is an advisor who stole $4.5 million worth of friends and family's money and used it gambling. Now that advisor's in jail. But we'll talk about how that impacts compensation scheme of last resort. And then the last thing we want to talk about is this new upcoming development with Shield Master Trust, so investment funds that have been, basically collapsed, and how that is leading into claims going to AFCA. Now, these companies are in liquidation, so AFCA can't charge the funds or can't charge the licensees, and so the money goes into compensation scheme of last resort, which, as advisors, we get to pay for.
Yay!
So let's start off. Is there anything, before we talk about Dixon and what's going on there, is there anything that we haven't talked about just to set the groundwork of what compensation scheme is?
Maybe around what the initial costs were first looking to be, how they're looking now.
Yeah, so the 24 financial year bill, we paid that. That was only really for 8th of April to the end of June.
Yeah, so 3 months.
Yeah, and that was 2.4 million. I've written it down, $2.4 million. And we paid that. And as a business, that was, I was looking at how much our bills were. That cost us $1,500.
And how many advisors did we have at the time?
Yeah, I think we had 7 at the time. Yeah, so we'll touch on that. And the other thing is we hate using acronyms, but we're going to probably use an acronym, either CSLR, which is Compensation Scheme of Last Resort, or Compensation Scheme. So talk to me about Dixon. What happened with Dixon Advisory?
Yeah, so Dixon Advisory, they're, what's it called, a head owner?
Evans and Partners, who
Yeah.
was the ultimate owner of Dixon Advisory. Dixon Advisory was a subsidiary
Yes.
of Evans and Partners.
Yes.
Yeah.
Evans and Partners was listed on the ASX, I think it was 2019. Not long after that, as often happens, you have an IPO, the share price is quite high. In this case, the share price started to go down quite a lot because at the same time, Dixon started receiving a lot of complaints. In 2020, they received 90 complaints to AFCA. That's another acronym, so the Australian Financial Complaints Authority.
Nice one.
And so they're the main body that you can go to if you have a complaint about financial service that you're receiving. And so 90 complaints in 1 year is quite high. They also were looking at a couple of class actions, up to 500 million, I think I was seeing in a judgment I was reading. And so all of this had came about because everyone's share price was starting to decrease. They were all invested in US property market fund.
Yeah.
And so it was a trust that was failing.
Yeah. So the investments in the US were, just not performing very well. And so, the way that clients went and got invested in those funds is via financial advice. And so the advisors at Dixon Advisory went and set up their clients' funds to invest in this kind of in-house product where Evans and Dixon were kind of like ultimately owned the fund. And so we're getting revenue based on the management fees of these funds.
Yeah.
So that fund basically blew up, fell over. You went kaput.
Evans were earning about 90% of their revenue just from the management fees of Dixon. So Evans was being, I guess, propped up by the management fees as opposed to the investment vehicle.
Yeah. And the great thing about Evans being publicly listed is they have to do financial reports on their performance. And some of the things that frustrated the most for me was what happened is Dixon Advisory, they knew that they were going to be liable for all these AFCA complaints and these claims because a client takes a licensee to AFCA and then AFCA says, yes, they're in the right, you need to pay whatever that number is. And so $100,000 because the client's lost that much money in your fund or, because of bad advice. So whatever that financial loss was, then the licensee has that bill. And if that licensee is no longer around, then they don't have to pay the bill. What happened is Dixon basically knew this was coming. Evans and Partners knew this was coming, and so what they did is they transferred all their advisors from Dixon into Evans and Partners, into the other licensee that they owned, and transferred a significant amount of clients. And so I don't know if you've got it in front of you, but in terms of like how many clients moved across, because it's all in their public filings.
It's all there, yeah. I only have the number in my head for Shield, not Dixon.
Yeah, I remember reading it some time ago because it's over a number of years that they were talking about, because in financial reports, they always talk about what's their growth plans and where do they see they're growing, opportunities.
The director's reports where they really fluff themselves up.
Yeah, and so they, pre-blowing up of Dixon, they talked about how great it was and, this is the way that we're going. We're going to move into advisory, funds management, all this jazz. And then once that blew up, they were talking about, okay, now how great is it that we've retained, 3/4 of our client base because they've transitioned the Dixon clients over to Evans and Partners. How great is it that we've retained a lot of our advisors? And so that's for me the big issue is what they did is they transferred a lot of those clients across and then they were able to just liquidate the licensee company. And so all this money that was owing, and like we're talking hundreds of millions of dollars owing to their clients, went to the compensation scheme of last resort. So
yeah.
That's one big issue. I don't know if you want to talk more about. There was class actions, as you said, and people taking a class action against Evans and Partners and Dixon, and it ended up being, I think, $16 million payout to that class action. So there was a bit of money that the company did lose.
Much less than initially was projected to.
Yeah, I mean, heaps less than what was actually
the actual
lost.
losses. Yeah.
And 16 million. It's like 20 times that is what's going to be paid out by the compensation scheme of last resort. And the real issue is, I mean, for me, some of the issues are, and we'll talk a bit more about it, but the fund failed. Like the advice wasn't great, but the fund failed. Had the fund not failed and performed well, then the advice would have been seen as probably appropriate. And so, that's a concern, and the fact that people can just close down a licensee and just waive their responsibility.
The advisors over, ship the clients over.
Yeah. And so, is there anything else, before we move on from Dixon, is there anything else about Dixon that we want to touch on?
There is a case that ASIC tried to bring against one of their directors. Do we want to speak about that?
Let's go.
So Paul Ryan was director at the time, and at some point they had a board meeting and everyone got to vote on if they wanted to change their constitution so that instead of acting in the best interest just of Dixon, they were acting in the best interest of the parent company as well. The vote, as the director of the company, it was alleged that maybe his vote was going to prejudice everyone else's, and so by him voting yes for it, it was alleged that it prejudiced everyone else to say the same. After that vote in December, they then they had their receivable to the head company waived. So there was $19 million that Dixon were saying as an intercompany loan they were expecting to receive from Evans and Partners.
Yeah, so I'm not an ex-accountant, so Evans and Partners owed Dixon $20 million.
Yeah, $20 million.
Let's round up. And then Dixon went, you know what? All good, bro.
All good, bro. And then voluntarily went into administration about 3 weeks later.
Right. So any money that they had owing, because when you go into administration, the liquidators go, okay, what are we owed? Let's get that money. And so they would have gone Evans and Partners, let's get that $20 million. But there was no longer that debt owing to them. So when the liquidator said, what are we owed? Okay, it's nothing. And then what can we pay out? Well, there's nothing there. So, happy days.
Yeah.
Now, look, again, we're not journalists. We're not here to slander anyone in particular. That is on the public record what happened, and ASIC took that case. Unfortunately, they didn't win the case against him. Do you have any spicy take on the judgment of that case?
Look, it's just curious going and reading the media release from ASIC, trying to understand and see the thought process behind why it wasn't, why they didn't win. It's curious.
Yeah. So basically, ASIC went, because what Dixon had done, they call it phoenixing the company, like just saying, hey, we're putting it into liquidation, all the assets, all the clients, all the staff, let's move into another company. There's actually nothing illegal about that, unfortunately. So ASIC can't say, oh, you're not doing what is kind of probably seen as the right thing to do. And so what the case they had was basically, this director wasn't acting in their duties, in the best interest of that company. And so that's kind of their case, which is, is more than reasonable to go after someone for doing that. But, it would be better if there was, better kind of, guardrails to not allow the whole fiasco to happen. And had this compensation scheme of last resort not been there, the clients would have lost their money. And the clients of Evans and Partners or Dixon may not have gone back and still be clients of that company because they lost their money. And so we can move on from Dixon because there is heaps of writing about it. Like AFR have written plenty of things about what's going on
because
there.
It is listed as well. There's so much more information publicly available compared to, say, Shield, for example, or another managed fund that isn't listed on the ASX. So,
yeah. All right. So next kind of thing that Keith Ford from IFA actually discovered this, and it was great journalism, like absolutely so good, because he went in the compensation scheme. It's all like the auditor's report is there. Everyone can read it. No one has apart from Keith and maybe one more person. And so he looked at this name because, with the compensation scheme, it's based on the licensee. So it's like, if us as a licensee, we did something wrong, our name, Skye Money, would be listed, but Ash wouldn't, even if you were the one doing the wrongdoing. So he'd noticed this company or this licensee that was listed, realised that that same licensee transferred 16 authorised reps away from their licensee into another licensee, I think at the start of this year, which is a little odd. And that licensee, that company or that business that transferred licensees also had an advisor in that business go to jail. And so, which is all public. And so he went to jail for stealing friends and family's money. And what had happened, basically, he had a gambling addiction, stole a whole bunch of his friends and family's money. They all lost their money, $4.5 million on a gambling addiction. Now he's in jail, rightfully so. But, if you lose your money under criminal pretenses, you don't get it back. And so there is kind of very little recourse. If you steal a whole bunch of my money and then you go to jail and you lose it and it's not recoverable, there's nothing I can do about it, except he was a financial advisor. And as a financial advisor, you're licensed under an entity. So all these clients went and took the licensee to AFCA, and the AFCA found in favour. Now, it is a really interesting case because, yes, if you, were authorised by Skye to steal $4.5 million, then it's reasonable to come after Skye for it because, or Ash, is authorised under Skye and, under our name. The fun thing about this case, and not fun because compensation scheme has to pay for it, is that the business had no idea. Like, I kind of feel sorry for the business, even though my original reaction was that business is should have done more. But after hearing a bit more about what had happened, at the end of the day, how does that business know about it? And so basically what had happened is that licensee, or the business just transferred licensees, and they were self-licensed, just like Skye, and then they shut down the license because they'd just seen Dixon do it, a few years before. So why don't we just do the same thing? And then that $4.5 million bill that was owing doesn't need to be paid for by that business. So that's kind of what happened with that case. What's your thoughts on that scenario?
It shows a bit of a systemic situation or a blueprint for if you do have a situation, someone's coming after your licensee. Okay, goodbye licensee. Hello, new people 2.0.
Yeah, and that's the thing. It's like, with our business, and it's good to give a representation of what it's like in reality. So Skye Wealth is a company which we trade under. So that is where we provide financial advice. Skye Wealth is licensed through Skye Money as a licensee. And so Skye Wealth, we could reasonably change licensees in the future. And so if something was happening, and these things take a long time to eventuate and blow up. So Skye Wealth could say, actually, we want to change licensees, which is totally reasonable.
Happens all the time for perfectly normal reasons.
Yeah, it's totally normal. And then, Skye Money, the licensee, can just shut down if we do have any cases. And the other thing is, with this case, is professional indemnity insurance doesn't cover the bill because it's criminal acts. They wash their hands of any bill because it's criminal acts and they're not allowing that. So, my original reaction was I was annoyed at the licensee because we're paying that bill. But then also, I did have a lot of empathy for them because at the end of the day, there's a human being who had nothing to do with the business. There's no way the business would have known. It's not like it went into the business accounts. It went into the guy's personal account. So I was like, how is the business meant to know and then get stuck with this bill? So I guess it's kind of also a frustration that AFCA, and again, people lost their money, $4.5 million. Like, you can't, just move past that. But AFCA going in favour of that as well is a little bit rough, I guess.
It seems like there's a mechanism in place to support people who have been harmed financially, so just easy to default lump it back onto CSLR.
Yeah, and it's a difficulty because AFCA's ruling was, well, this person used company letterhead and it was reasonable that the clients assumed that the company was involved in what was going on. And it's just so scary. How do I can't reasonably monitor your own personal emails that you
Yeah.
send out, like that's illegal. So there's no way, I could stop that happening here. Other than the fact we don't do investments. So if any one of our advisors is asking you to put any money in any investments, don't believe them because that's not what we do. So, yes.
Yeah, it's interesting that they say you would reasonably expect, which, if you're seeing it on a letterhead, but think if they heard the full picture, I'm not sure that they would have the same outcome.
Well, no, I don't think. Like, I think at the end of it, the victims of the crime would understand that business wasn't involved. But if I'd lost $4.5 million and I knew I could go after that company,
if you can go after someone, you're going to want to go after someone.
Yeah, like why wouldn't I? Because I was wronged and, I did lose the money. A little bit more complex. It's ongoing issues at the moment, so we don't know what the actual bill's going to be. There's heaps of different businesses involved, but overarching, it's kind of Shield Master Trust or First Guardian Master Trust. So these are investment vehicles as well. So talk to me about what's going on here.
Yeah, so the main thing that was happening here is Shield is an investment vehicle as well. They were also another vehicle that's fallen over. They had a licensee, Financial Services Group Australia, who had lots of different financial advice firms under it, as you were saying before.
Yeah.
So there's still a lot of work being done to work out actually who was involved, what was going on. As part of their business model, they were doing a lot of advertising through Facebook, Instagram, this sort of thing, for predominantly self-managed super funds. So they were making it look all shiny and good, promising really good returns, and then getting you to put in details so they could contact you. They would then use those details and contact you, sort of until you went ahead from the sounds of things. When you went ahead, they would, as they have to do, provide you a statement of advice, all of the normal financial services things, and then set you up with the Shield investment or whatever it may be, whatever was appropriate.
Well, not whatever was appropriate. It was Shield and First Financial. And one of the fun facts about this is one of our team members' good mate was impacted by this, lost his super balance. And so we've got the original statement of advice as well. We've got a whole bunch of data, information about what's happened there, but we will probably do another video on it because we can deep dive, and he's been very generous to kind of allow us to talk about it in a lot of detail. But basically, I'm looking at the advice document. It's like, hey, you don't have any personal insurance, and let us know if you want it. Hey, you've got this super fund here, but we're going to move it to this super fund, and we're going to charge you an entry fee of a percentage-based entry fee, and we're going to invest you in these two funds. It was actually 3 funds, but two of the ones that fell over. So so because it's advice, and because investment management is not a part of CSLR, the individuals who have been impacted can't go to AFCA and say my investment has tanked and I want my money back, but they can with advice because personal advice was provided, so they can go to the licensee and say, hey, one of your advisors provided me personal advice, told me to invest in this, it was inappropriate advice, I want to go to AFCA. And so that's really what the AFCA complaints are about. One of the things that's important to note is we've got all these people and members of these funds and these super funds that are impacted and they're losing their money.
It was about 5,000 investors through Shield and about 3,000 with First Guardian. So lots and lots of people affected.
And there are rules around anti-hawking. So we can't just pick up a phone book and start calling people and say, do you want personal insurance advice? Because that's not allowed. There are anti-hawking rules. But the way some advice firms have gotten around it is they... and in this case, there was an advice firm who set up a marketing firm, and as a part of that marketing firm, did a lot of Facebook advertising this. So, I'm sure you've seen it on social media.
Definitely.
About move your super over here and we're getting great returns, or set up a self-managed super fund. All of that stuff is not done by the advice firms because they try and protect themselves by setting up a marketing firm. And then once you click on those ads and you give your details, then it's free reign. It's not anti-hawking because you've given us the opportunity to harass you, basically.
I feel like it's similar to a lot of people probably would have experienced if you use a comparison website. You give them your contact details and then they just keep calling you until you've gotten that product, whatever you were trying to compare.
Worst. Like I've been getting car insurance, you just chuck your details in. I just want to see the numbers.
Yeah.
And you just like, phone rings 3 seconds later. So that's kind of the issue there. And we don't know what the actual end bill is because a lot of these complaints are only just starting and they're not even in the system yet.
They went into administration only earlier this year, so the administrators don't even know what the full financial impact yet is.
Yeah, so that's a bill that's on the horizon. So Dixon is baked in. A lot of that cost is baked in. Actually, a lot of that cost was funded by the Big 10 institutions before it got to us. So thank you all the banks out there and the super funds out there paying that initial bill. And then this case where someone stole money is going to be baked into the 2026 financial year numbers. And so it's really interesting. And the Guardian, we don't know. It's kind of this untold bill. So the CSLR, the other thing is there are sector caps. So talk to me about what those sector caps are.
Yeah, so there's 4 different sectors involved, financial advisors being one of them, and with the sector cap for each sector being $20 million.
Yeah.
So when they first proposed, or the first round, it was saying that financial advisors was going to be about 2.4 million. Second round was going to be about 18 million.
Yeah, 18.5.
Since then, the figures have really blown up. So to see what will come for this financial year is a bit of an unknown.
So the 18.5 is the 25 financial year. So we actually haven't received the bill for that yet.
Yeah, gotcha.
And I will try and calculate what that's going to cost us.
Yeah.
And then the 25-26 financial year is just estimates.
Yeah.
But the estimate so far is $67 million. So we're going from 2.4, 18.5 to $67 million. So correct me if I'm wrong, 67 is more than 20.
I think so.
Yeah.
Yeah.
So that $20 million cap, now that's where it gets interesting. Now, if you've watched this far in, you may be interested in it, but if you're not interested, you wouldn't have come this far. So the $20 million cap is going to be, breached. Now, the Minister for Financial Services gets to make a decision. Now, there's a few decisions that they make. The government can pay the bill and go, well, maybe we should be protecting consumers as well. So we'll out of the generosity of our heart, we'll pay the bill. And obviously the government's got to fund that, which all Australians pay that bill. The other option is they just say, I know we've gone over the cap, but bad luck, your industry's caused the problems, so you pay the bill. So then it gets spread across all the advisors in the market. And the other one is they can spread it across the other industries. And all the mortgage brokers in Australia are going, what the heck? Why would we pay that bill? Why does it get shared amongst us? Because, there's $47 million that's unaccounted for. And the minister's just recently, I think at the start of August, has just said, hey, I'm going to go out to consultation. Or Treasury's gone out to consultation. What should we do with this $47 million proposed bill? I'll probably write something. I've never written anything in any of these consultation papers ever. I help, I communicate with FAAA and do some stuff there, but I've never written my own thing, but I think I will for this because it's maybe really grumpy. But yeah, we don't know. We don't know what that bill's going to be, and it'll hit us August 2026.
It will be very interesting to see what happens. I'm sure if you're watching this far, you'll probably be up in the discussion as well through to August of next year.
Yeah, so, we've talked a lot about what are some of the major systemic issues, but I'd love to hear kind of your thoughts on what are the flaws with this compensation scheme?
There's a handful of flaws that have been highlighted through the cases of Dixon Advisory and the Shield Master Fund shutting down. One of the first flaws is that with Dixon highlighting, you can just close your doors and start again. Having it come through a licensee, have that licensee close, and then open a new licensee, move the advisors across, move the clients across. The financial effect hasn't directly hit them. Obviously, they're paying for it still through the compensation scheme of last resort, but that's only a small fraction of what they would have paid otherwise if they hadn't, closed and started again. particularly with, being able to move some of their funds over to Evans and Partners. Another flaw is that the mechanism is only so that they can go after financial advisors as opposed to being able, or the licensee, as opposed to being able to go to the investment scheme that has fallen over. So with Shield being the investment vehicle that's fallen over, or First Guardian, they're just able to close, no worries, no burden on them, goes back to the financial advice industry instead.
Yeah, and I mean, on top of that, it's also the platforms that allowed it. Like there is a big, I'll name them because it's true. Macquarie is an investment platform, one of the biggest in Australia. They allow these funds to be on their platform, to be invested through their platform. And so, there is no recourse on them. There's no recourse on the actual investment management. And the idea being that investments are risky. If you lose your money, can they really be held liable? Because, and I understand why. If AFCA allowed it, any time that dips 1%, everyone's going to make a complaint that this investment fund lost some money. And why didn't they outperform the index? So I can understand why there's maybe this we shouldn't allow a compensation scheme to go to them. But these failings have been investment failings and not predominantly advice failings.
Surely there should be some sort of line between 1% and going into liquidation or administration.
Yeah. What else is the issue?
Well, particularly for us at Skye, we're life insurance only. We have no investment component to us. The majority of complaints in financial advice are around investing, or if not investing, there's just very, very few that are about life insurance advice.
Yeah. So there's over 100,000 complaints go to AFCA every year. Most of them are in banking and finance, and this is anything from my bank won't let me close my bank account quick enough. There can be fairly minor things, and advice. Advice makes up 3,500. So we're talking 100,000. Advice in itself is 3,500, and that includes all of these, AFCA complaints towards Dixon and there's other ones we haven't even talked about United Global Capital, which is another.
I think they're up
big
to
thing.
about 2,000 complaints just for Dixon.
Yeah, and that's over a number of years. And so, I remember going to a Risk in Focus PD day, and someone from AFCA was talking about, I think from memory, in a 12-month span, it was less than 70 complaints on insurance advice. I almost think that, Skye's never had an AFCA complaint, but I almost think that Skye will pay more money towards CSLR bills because of the investment failings and the advice within investments than if Skye just put our hands up and say, we'll pay 100% of all insurance-related advice determinations. I think we'd save money doing that, even if we're not involved in any of them.
Sounds like you want to be segregated, like the mortgage brokers looking at this going, don't touch us.
No, we're all one. We're all one family, but it is. I want to actually bring investment management into it because it's really investment failings that are a big issue. And one of these things that, people talk about, well, you're all advisors if there's dodgy people doing dodgy things. Most advisors know who the dodgy things are. We see the Facebook ads as well, and we can report them to ASIC and they don't do anything. And so it's kind of frustrating because we know what's right and what's wrong, and who, we see these advice documents and we go, well, that's clearly dodgy advice. Let's report it. And then it just feels like it doesn't go anywhere. And I guess the other frustration I have is, the flaw in the system is AFCA's way of determining the loss is, if not for bad advice, where would your net position be? So if you invest $100,000 and, over 5 years, if not for bad advice, you would get $130,000. Well, that's a determination. It's $130,000 when the loss was only $100,000. Well, not only, it's $100,000. But with a lot of these determinations, well, not a lot, but there's quite a few within Dixon where they return their money back to them. If not for bad advice, they would have been much better off. So they invested $100,000. 5 years later, they got $100,000, but they made a complaint and they got that $30,000 gap from the compensation scheme, which is kind of, again, I can understand why they're doing it, but it's there is no risk from an investor's point of view. If I invest badly and the advice is, bad, but it goes up by 200%, well, I win. If it goes down, I get to get my market return still.
Sounds like advisors need a version of this to then go to the investment managers.
Yeah. If not for Vanguard, I would have gotten this. Give me my money back. Yeah, and the other thing, I just kind of want to finish this discussion. Is there anything else? I'll finish this discussion to talk about how does this impact clients? Because it costs Skye money. Now, so we're not here to whinge and complain, but just here to go, this money that we pay does get passed on to clients because we're running a business. And this is not just us, this is all advice firms. And so before I kind of do my final maths, is there anything that we haven't kind of touched on that you think is important to talk about?
No, my final question for you was going to be, how does this come back to affect clients? In a few of our This Week at Skye chats, we have been talking about how CSLR costs are affecting the financial advice affordability. We've talked about before how there are a lot of young Australians who do understand the value of advice, they want it, but before all of these CSLR costs, it's still quite expensive, an initial fee to get holistic advice. With all of these additional costs looking to be added into CSLR's anticipated bill for next year being $67,000, how's that then coming across?
Yeah, so I've done some math. There's a few things to talk about is ASIC. We get an ASIC levy on a per advisor basis, which is fairly new as well. So we've got this compensation scheme levy and ASIC levy. This ASIC levy is only, as I said, only new, and we get charged $1,500 per licensee and then a per advisor cost of $2,314, which is what it will be next year. And so I've calculated that for our business. We've got 11 advisors, so it's $25,500 for that ASIC levy. So we pay money for the police to go after, the bad actors. And if they don't do their job well enough, then the bad actors, the money just gets compensated back to us. So ASIC get funded by us, and if they, fumble the ball, then we just pay the bill anyway. So it's a crazy way of running an industry, but that's the way it is. So $25,000 is what we'll pay, or 25.5. It's what we'll pay for the ASIC levy. This next bill that I'm expecting to get, it should have come in now because I got my last bill last year in 5th of August, will be around $13,000 for the business for 11 advisors. Mm-hmm. Now, this $67 million bill, assuming they pass it back to the advisors, which if I'm a betting man, I bet the minister's going to just be like, well, because the story is, well, here you go. Why wouldn't you pay it? Because your sector caused that damage. And I'll just quietly say, well, the sector who caused the damage isn't included, but that's okay. That will cost
just quietly
Skye,
on the recording.
Yeah. That'll cost Skye $47,500 for the compensation scheme, plus the ASIC levy.
Yeah.
So let's say we don't get any more advisors in the business, just compensation scheme and ASIC levy is $73,000. And this is all new levies. Like, we didn't pay this 2-3 years ago.
Yeah.
So now my question for you is, do you want to go out and start your own advice business?
I was thinking the same thing. All I was thinking was, good luck to anyone wanting to start an advice business. My goodness.
Yeah.
Because there's so many costs already just to get yourself off the ground and get started in an advice business. To be whacked with all of this immediately.
Yeah.
Whoa.
Now, look, I'll divide it by 11 because, it's $6,600 per advisor.
Exactly.
So, yeah, and it's not even just the cost to start your own business, but it's also for new advisors and businesses hiring advisors.
Yeah.
If it's going to cost just under $7,000 to hire
Just
an
add
advisor, then it's really expensive. And the government's talking about making access to advice easier, and there's this big problem about not being able to bring in young talent into the industry. Well, if it's going to cost $7,500 per advisor, it's going to significantly limit the ability for advice firms to bring in new talent.
Yeah, I think holistic advisors, they normally average, once your book is built up, about 100 clients. So it's $70 per client,
Yeah, exactly. Yeah, per year. That needs to be forwarded on to the clients. This has been a good chat. Thank you, Ashley, for doing a lot of the research and deep dive. And as I said, this is a topic that we've both researched more than we should have, if I'm being honest, because the bill's going to be the bill, regardless of if we whinge about it or not. But before we finish up, is there anything that we haven't touched on or you just kind of want to reiterate?
It's just really interesting how the compensation scheme has been set up and AFCA's way of calculating it. There's a lot of flaws in this area that it's hard to imagine how a similar situation would be handled in a different industry. To see the way that it's being handled in financial services doesn't happen anywhere else.
The compensation scheme of last resort really is, it's someone who goes into a bank and robs a bank, and then the bank says, for us to be made whole, anyone who's ever walked into this bank in the past needs to pay us back this money. And the government going, yeah, you know what, that's good, let's do that.
Sense.
Yeah, makes sense, bro. And so that's kind of the flaw in it. And then everyone who's in the bank and who's used the bank in the past also pays for the police to make sure that that doesn't happen.
Yeah, if the security fail.
Yeah, when the security, are falling asleep, and then let that happen, then we're all funding the security guards and the stolen stuff. So. Anyway, I could rant for another 45 minutes easily, but that will not be compelling. And thank you very much for getting to the end of this education session. If you do have any questions, please reach out. If we've made any false statements or inflammatory statements, then don't come after us, please. We love you, ASIC. We love you, APRA. We love you, CSLR. And if you do want to watch any other deep dives, you should see some on the screen right now. Thanks heaps for watching.